I'm your host and question master for this pre-recorded session. My name is Tom Barbour and I'm the head of FX options trading at Moneycorp Bank in Gibraltar. Within the next 20 minutes or so, I'll be speaking with Neil Parker, our head of economics and market strategy, covering a range of topics related to both the global economy and Gibraltar's economic outlook. As this is a pre-recorded session, there won't be a live Q&A, but if there's anything you'd like to explore further, please feel free to reach out to your Moneycorp Bank contact or the team at mcbteam@moneycorp.com. So, without further delay, Neil, let's delve into the first topic. Nice and broad to begin with, looking at the global economy. How do you see things looking for growth, inflation and interest rates globally, given the recent developments in geopolitics, specifically with the conflict involving the US, Israel and Iran?
Yeah, this is an interesting one because ultimately, I think before the year started and before the conflict got underway, many people were more optimistic about the outlook for 2026 versus 2025. They thought that the effects of previous interest rate reductions would be helpful for growth, whilst at the same time not eliminating the downward track of inflation back towards its target. But now that we've had the situation in Iran and in the Middle East more generally, I think the risks on inflation are definitely to the upside and probably more so because of the medium to longer term damage that's been done to the energy supply sector. But equally, there are other sectors that are materially affected by the situation. So things like around about 40% of the world's fertilizer comes from the Middle East as well. So things like the agricultural sector will be impacted by that and potentially see costs increasing there as well. Not only that, but you've got pressures on the travel industry. We might see some big changes to the way in which people fly or the destinations in which they visit in 2026. So overall, I think there are upside risks to prices and inflation, but some downside risks to growth because the vast majority of the areas that are going to be impacted by this war are things like necessity goods, things such as your home energy bills, things such as the cost of petrol and diesel at the pumps. But not only that, things like food prices and other necessities, clothing, footwear, etc., because of the increased costs of transportation and freight. So the global outlook looks weaker than it did. Not only that, it's probably weaker than when we saw the thing in Ukraine in 2022 when Russia invaded. The effects of that were seen as more short term and were predated by already upside inflation risks. We didn't see the same upside inflation risks prior to this war breaking out. So I think it's a very different situation this time around versus the Ukraine war in 2022.
I absolutely agree. And we've already started to see, this feeding into the oil and gas prices. The markets have seen, a big spike in volatility. Do you think that this will have a knock-on effect directly on Gibraltar, for example? Could we see upside risk to inflation in Gibraltar as well as downside risk to growth?
Well, I think the upside risks to inflation are probably global, so Gibraltar won't be immune from that. And undoubtedly, I think they will already be seeing rises in prices at the petrol pump, whereas the rise in energy prices will take longer to feed through, but they will still be significant. But in terms of the outlook for growth, I think these are potentially dual and opposite. So there's some upside risk for Gibraltar in terms of that if passenger ships, particularly cruise ships, are being diverted to different locations, Gibraltar might benefit from that. And so from the tourist perspective, it could be a positive. It could also be a positive in terms of trading routes having to be switched and therefore Gibraltar being utilised more so from a port facilities perspective for the transit of goods. So again, that may be a positive. But on the negative side of things, if the population of Gibraltar is feeling squeezed by the rise in prices, particularly of necessity items, then I think that will be a negative for things like discretionary consumer spending. So as I say, it's dual-handed here. It's not they're all in one direction. There are some upside risks and some positives, but there are also some fairly serious negatives because of the rise in prices, which, by the way, even if this conflict were to see a ceasefire agreed tomorrow, still will have some longer lasting effects because of the destruction that we've seen to the energy supply and energy storage sectors within the Middle East.
It's interesting because over the course of the last, say, 18 months to 2 years, we've seen major central banks around the world looking to, well, they've been in a cutting cycle. That's now looking to be flipped on its head. We're looking at, interest rate hikes over the coming months around the world now. Could you see the Bank of England hiking rates in the coming months at the next meetings in order to counter second round inflation effects?
Well, hopefully not, and hopefully we have seen from the Bank of England Governor Andrew Bailey that he's trying not to overemphasize the issues around inflation. Many of those inflation pressures, by the way, are not going to be touched by raising interest rates by a quarter or even a half a percentage point. So if they were to look to try and dampen down the inflationary effects from the second round, you'd probably have to look at much larger increases in interest rates. But I thought it was interesting listening to the chief economist of the Bank of England, Hugh Pill, when he was talking. He was saying, well, we look past the peak in 2022 and 2023 for that matter, and we're going to have to look past the trough as far as the falls in inflation that we were expecting to see. Well, this will be a blip in terms of prices. It might be a more prolonged blip than we were expecting, but it's a blip nonetheless, unless you're expecting energy prices to just keep climbing from here. And I don't think that anybody's expecting that. So the Bank of England shouldn't be too reactive to the situation that we're seeing at the moment. They should take a much calmer, cooler-headed approach to the pressures that they're seeing, and consequently, I don't think that they'll be raising interest rates, irrespective of what the market is pricing for. I mean, at one stage yesterday, which was Monday, the 23rd, we were seeing almost 4 interest rate increases priced for by the financial markets from the Bank of England. That just doesn't make any sense whatsoever. It would virtually guarantee that the UK economy runs the risk of falling into recession, because economic growth has been pretty anemic in the UK, and that of course again will feed through onto Gibraltar. And if we're looking at trying to support the supply side of any economy, whether that's Gibraltar or the UK more generally, then interest rates ought to be lower than they are currently to support the investment cycle that's very much required. If we were looking at simple things like the investment in green energy, for example, then that would require, I think, lower interest rates in order to provide the sort of returns and security that the UK economy so desperately needs. So major central banks need to be very, very careful about overemphasizing the need for higher interest rates in this upcycle of price pressures driven by the Middle Eastern conflict.
I completely agree. And Neil, obviously, we're in the midst of a material change here in Gibraltar. Moving on now to our second topic. And since the UK formally left the EU at the end of 2020, Gibraltar's remained the only UK territory to remain under what's been known as temporary arrangements. However, with the recent the deal between the EU and Gibraltar itself coming into effect next month, how could this affect the outlook for Gibraltar going forward?
Well, I mean, it's an interesting one because it will mean some fairly sizable changes in terms of travel, but also an easing and a prolonged easing of the issues that had been causing Gibraltar some serious headaches with regard to the border between Spain and Gibraltar and the transit of around 10,000 people per day onto the Rock. I do think that it's got the potential to be positive. It offers significant positives as far as Gibraltar is concerned, as far as the movement of people, as far as the easy transit between the La Linea region and Gibraltar itself. So it could see significant increase in investment in that region. over the course of the coming years and such like. But clearly, it is a big change. So we don't know what the entirety of the effects are going to be. But I think we should look at this more positively in terms of trying to bring investment into Gibraltar, greater use of the ports and airport for transit into southern Spain. So I do see it as a potential positive, but clearly, as with any deal, and we saw this with Brexit, for example, there will be potential teething problems, and it's a question of how both sides react to those teething problems and trying to resolve them as quickly as possible. Overall, though, I look upon this as a potential net positive for Gibraltar because it does possibly offer Gibraltar some significant benefits that won't be available to the UK mainland. So perhaps that's the way that Gibraltar could leverage this deal with the EU to continue to make themselves relevant.
Absolutely. And we've seen, as you've mentioned there'll be greater mobility, the opening up of the airport to additional EU destinations and not just the UK as it is at the moment. And the cross-border mobility aspect is very important, not just for Gibraltar, but for the wider region, the Campo de Gibraltar. Do you think that the agreement will have a positive impact on the wider region and the neighbouring areas?
Again, I think given the sort of tourist sector, I think it definitely could. I know from personal experience, for example, that we use Gibraltar as the hub to transit into Andalusia on several occasions because it was the easiest airport of access. Far easier, for example, than Malaga, which was further away than the destination that we were traveling to, which was Estepona. So I do see it as a potential net positive for the region generally. And as I say, bringing in investment to that region, which Andalusia has been one of the poorer regions of Spain over multiple decades. So consequently, I think that this could be a significant net positive for the region in terms of bringing in much needed investment.
Totally agree. As you say, La Linea specifically is known as being one of the most deprived areas in not just Andalusia, but in Spain as a whole. And it's funny, in fact, if you leave the border now in Gibraltar and you head out into La Linea, you can see there's been a lot of redevelopment. There's a new shopping centre in the process of being built, and the property market there is rising also. A lot of demand in the area locally. So I think it will be positive not just for Gibraltar but for the region itself. And then linking this all back into one, in terms of the geopolitical troubles, let's say that we're facing at the moment. What does that mean for what impact will that have on currencies?
Well, I mean, I think the one that most people will look at is sterling euro, and sterling euro has been much higher. It was much higher in 2025. It got over 121 at one stage, but has now settled back into a more normal trading range. And I think what's been noticeable with this conflict in the Middle East is that neither the euro nor sterling has really been able to benefit against each other. They
Yeah.
tend to be trading almost uniformly against the US dollar. So we haven't really seen sterling make much headway. It's pushed up towards 116 in against the euro on a number of occasions, but never really held at those sorts of levels. And equally, when we move lower, and we moved lower at the very beginning of the conflict and moved below 114 at one stage in sterling euro, it didn't hold there either. So I think that's the trading range for the time being. My concern would be actually if you look at how interest rate expectations have changed between the UK and the euro area, they have changed far more dramatically in the UK than they have in the euro area. So whilst markets are pricing for some tightening from the European Central Bank, they're only pricing in a couple of rate increases this year. from the UK, at one stage, as I said yesterday on the 23rd of March, they were pricing in almost 4 rate increases. Now they're pricing in around 2.5 rate increases. But realistically, the UK still needs additional easing. And I think were there to be some sort of resolution in the conflict, which is dominating the headlines at the moment, and we rebuild those UK interest rate cuts, that closing interest rate differential could put some additional pressure on sterling euro, driving it down below 114 and potentially as low as 110, 111 over the remainder of this year. The pound needs to find a base, and I don't think it's found it yet. And it won't really find that base, in my opinion, until we do reach a base as far as UK interest rates are concerned. And that base might be 3.25%, or it could be lower than that. It could be 2.5 to 2.75%, based on the poor performance that we're seeing from the UK domestic economy. So overall, I'm still relatively pessimistic as far as sterling euro is concerned, but that's predominantly based on the fact that I think UK interest rates have a lot further to travel to the downside than European interest rates do, if there are going to be any interest rate cuts from the European Central Bank at all. And as I've already laid out, I think the markets are completely overcooking their expectations as far as interest rate tightening is concerned on the back of this conflict.
And in terms of the dollar and any other major currencies, are there any other currencies that we should be taking into consideration, or any other risks that we should be looking at, particularly if you're basing it against sterling?
Yeah, again, I mean, similar sort of thing, really, that sterling against the US dollar. I think there is weakness in the UK economy. There's some fiscal policy problems that we saw again manifest themselves in February. So public finances don't look in great shape in the UK, and that could be a net negative for sterling, particularly the amount that the UK government is purely having to borrow to pay off the debt interest costs of outstanding UK government debt, I think is problematic. And if we were looking at sterling dollar as well, the other thing to throw into the mix is, of course, we're in 2.0 of US tariffs, but those tariffs are only temporary. They will only last 150 days. We don't know where the UK's trade deal stands with regard to the US. It's not been made clear as to whether that still holds or not. And the UK has had some difficult diplomatic discussions with the US recently over the Middle East conflict. So all of those things create uncertainty and volatility, and potentially an asymmetric risk to sterling against the US dollar with those downside risks. But the US also has some political problems on the horizon with the midterm elections due in November. They have problems with regard to they're still actually in a partial shutdown that doesn't appear to be on anybody's radar at the moment. But part of that is affecting US travel, and so I do think that the US is by no means in a very strong economic position, but potentially at least they're in a relatively stronger position than the UK. So sterling dollar down towards 130, possibly down into the sort of high to mid 120s is where I see the risks. And even if it were to recover and rally, I think it's built up quite a lot of resistance in the sort of 135.5, 136 region. Might not even get to those sorts of levels. But that's kind of the range that I see sterling dollar trading in over the remainder of this year. One final point to note as well is that the US also has the possibility of changing the head of the Federal Reserve from Jerome Powell to Kevin Warsh. That's assuming that the confirmation hearings go smoothly, and thus far it's been anything but. So overall, some problems for the US to surmount, lots of problems for the UK to surmount, and sterling could be an underperformer generally against other major currencies in 2026, in my opinion.
So definitely interesting times ahead, not just for sterling, but I guess the global economy as a whole. So expecting a lot more volatility in the months ahead. Neil, that wraps it up for today. It's been really insightful, and thank you very much for your time. We hope you've all found this fireside chat useful. If you have any follow-up questions for Neil, please reach out to your usual Moneycorp Bank contact or email us at mcbteam@moneycorp.com.